The chart was watching you. Every candle that looked bullish, every breakout that felt confirmed, every perfect support line that broke the moment you placed your stop loss. None of it was random. It was designed, not by some evil genius behind a screen, but by the invisible mechanics of how large market participants operate. Like ocean currents, moving silently, shifting billions, while individual traders react to the ripples they leave behind. The market is not chaos, it's choreography, but many traders dance without hearing the music, copying the moves of those just as lost. Until now. Welcome to Trading Psychology Stick, where we decode the mind games behind every market move. Quick disclaimer, what you're about to learn isn't financial advice. It's pattern recognition. Use it wisely. After losing $127,000 in my first 2 years, then recovering to turn $10,000 into $1.2 million, once I understood institutional behavior patterns, I realized something most traders overlook. The market has a rhythm, and once you learn to read it, your perspective changes completely. Let me tell you about a trader I mentored. We'll call him Daniel. He had all the tools: RSI, MACD, Fibonacci, trend lines, order blocks, you name it. He was disciplined, studied every night, journaled every trade. But no matter what, he always seemed one step behind. His breakout trades got trapped, his reversals got faked, his confluence zones got violated without mercy. He started wondering if success in trading was even possible for individual traders. Then one night, watching Bitcoin consolidate for days, he noticed something. A sudden spike in volume with no price movement, like watching a deep breath before action. Not to move immediately, but as preparation for what would come later. That's when everything clicked. Daniel realized he wasn't just trading price. He was witnessing the footprints left by institutional order flow. In this video, you're going to understand these market dynamics. But remember, identifying these patterns is just one piece of the puzzle. Successful trading requires comprehensive analysis, strict risk management, and emotional discipline. You'll learn how to recognize institutional activity patterns, not just price action. How to identify potential manipulation before it completes. How to stop reacting impulsively and start trading with institutional awareness. Because once you understand the market's deeper structure, your entire approach transforms. So, are you ready to explore? Type learning in the comments if you've ever felt the market moved against you the moment you entered a trade. I'll wait, because that feeling, it's exactly where our education begins. Section 2, when institutions accumulate. Most traders only see what price has already done, but the real question is, what is it preparing to do next? And to answer that, you need to understand how large market participants build positions. The market doesn't move when you click buy. It moves when liquidity dynamics shift, when institutional traders quietly accumulate positions without moving price significantly. You see, while individual traders wait for confirmation, institutions work patiently. They don't chase price, they absorb it. Like engineers building a dam before redirecting a river, they accumulate, absorb, and position, all while maintaining price stability. To the untrained eye, the chart looks boring, but this consolidation is often preparation. According to a 2023 study by the Bank for International Settlements, institutional trading accounts for over 85% of daily Forex volume. These large participants can't simply market buy their entire position without moving price against themselves. They must accumulate strategically. Picture this. The ocean's surface is calm, but below, powerful currents are shifting. Institutional traders test market depth, analyze order book liquidity, measure retail positioning, and before major moves, they systematically build positions, absorbing selling pressure without allowing price to rise prematurely. Individual traders don't notice. They are focused on the quiet surface. Then suddenly, when accumulation is complete, price moves decisively. The breakout many never saw coming was actually weeks in preparation. Let's return to Daniel. After months of reactive trading, he began studying not just price action, but market mechanics. He noticed something consistent. Before major moves, markets would enter periods of compressed volatility. Volume patterns would shift subtly, price would hover in tight ranges, and technical indicators gave mixed signals. But then, right before significant moves, he'd observe large volume with minimal price displacement. This was institutional accumulation. He backtested this observation and found it preceded roughly 70% of substantial moves. Remember though, no pattern works 100% of the time. Markets are complex systems influenced by countless variables. What matters is understanding the probability and managing risk accordingly. And that's the key insight. Price doesn't move solely from technical patterns. It moves from supply and demand imbalances. Large participants don't push markets impulsively. They build positions methodically. And once accumulation is complete, supply and demand dynamics shift. Now ask yourself, have you been trying to catch moves after they've already started? What if you focused on identifying accumulation phases instead? Would you enter with better timing? Would you stop chasing extended moves? Would you trade with more patience and less emotion? But this is just the beginning, because understanding accumulation is only helpful if you can distinguish it from distribution. It's one thing to recognize accumulation. It's another to understand absorption. And the most patient traders don't chase price movements. They wait for the market to come to them. In trading, absorption occurs when large participants systematically take the opposite side of aggressive orders without letting price move significantly. Most people never recognize it because on the surface, it looks unremarkable. A stall, a pause, sideways price action. But underneath, something significant is unfolding. Large orders are being absorbed without price responding proportionally. That's not weakness. That's strategic positioning. It's not lack of interest. It's the presence of a large participant willing to provide liquidity at specific levels. Imagine you're observing ocean currents. Everything appears calm at the surface. The water barely moves. But beneath, powerful forces are at work. Every wave that tries to form is absorbed back into the depths. Every momentum shift is countered by an equal and opposite force. This equilibrium isn't random. It's maintained deliberately until conditions change. Daniel experienced this firsthand. He identified what appeared to be a perfect ascending triangle. Consolidation was tightening. Volume was increasing. Standard technical analysis suggested an imminent breakout. So, he positioned himself accordingly. But as soon as price reached the resistance line, it stalled, then reversed sharply. He was stopped out. He analyzed the order flow data later, and there it was. Clear absorption. Thousands of buy orders hitting the ask, but a large participant was providing liquidity, absorbing the buying pressure. Price remained flat. That institutional seller wasn't aggressive. They simply provided liquidity and let eager buyers come to them. The key point about absorption is that it appears passive but is actually strategic. It looks like equilibrium but is actually positioning, because it uses natural market flow rather than forcing movement. What I'm illustrating here is this. Markets are not simply reactive. They involve strategic interaction between participants of different sizes and objectives. The best opportunities often arise not from aggressive moves, but from understanding these dynamics. Absorption is when supply and demand appear balanced on the surface, but underneath, positions are being accumulated. So, have you ever bought into apparent strength only to watch price immediately reverse? Have you ever felt like markets were specifically hunting your stops? It wasn't personal. You were likely on the wrong side of institutional positioning. But don't be discouraged, because once you understand absorption patterns, once you recognize these dynamics, you stop trading blindly. You start observing order flow characteristics, reading market depth. And once you identify absorption, you can position yourself accordingly. If this seems complex, remember that all professional skills require practice. What matters is that you're learning to see beyond price action. Not every market move is a genuine breakout. Some are designed to generate liquidity, to trigger stops, to create order flow that larger participants can use for their own positioning. You've seen it. Price consolidates, builds pressure. Everyone watches the same levels. If it breaks resistance, they think it's going higher. Then suddenly, a strong candle breaks the level. Traders rush in, volume surges, momentum seems unstoppable. Then just as quickly, the move reverses. Price returns below the breakout level. What just happened? This is often described as a false breakout or stop hunt. But let's understand the mechanics. Let's revisit Daniel, this time analyzing Ethereum. Price had consolidated under $2,000 for several sessions. Technical analysts identified it as accumulation. Volume patterns seemed constructive. When price broke above 2,000 with conviction, he entered long. But here's what the order book revealed. Market depth was thin above 2,000. The surge in volume came primarily from retail orders triggered by the breakout. Meanwhile, A large participant used this liquidity to distribute their position. The breakout wasn't the beginning of a trend. It was an exit opportunity for someone who had accumulated lower. According to research by the Financial Conduct Authority, approximately 70 to 80% of retail traders lose money. Understanding why involves recognizing these liquidity dynamics. Because this is how liquidity generation works. It requires triggering predictable behavior. Large participants understand where stops are placed, where breakout orders wait, where emotional decisions cluster. They don't move markets randomly. They move them strategically to access liquidity. The key insight isn't that markets are manipulated. It's that markets are mechanisms for matching buyers and sellers. Sometimes creating liquidity requires triggering stops. Sometimes it means pushing price to levels where orders cluster. This isn't malicious, it's mechanical. You might wonder how to identify genuine versus false breakouts. The answer lies in understanding context. A breakout after extended consolidation with increasing volume and market breadth often has higher probability. A breakout on the thin volume after a strong move might be suspect. Have you ever felt like markets targeted your exact stop loss? That's not imagination. Your stop was likely placed where many others placed theirs. Creating a liquidity pool. Comment liquidity below if you've experienced this pattern, because recognizing it is the first step to adapting your approach. But what if instead of being liquidity, you learn to identify when others would provide it? What if you waited for these moves to exhaust before entering? Because after liquidity is generated and weak positions are cleared, that's often when sustainable moves begin. If you've ever missed a significant move, it probably wasn't because you were late, but because you were early. You entered during accumulation or liquidity generation, not during the actual distribution phase. Markets don't typically make their largest moves when everyone expects them. They move after positioning is complete, after weak hands are shaken out, after institutional participants have accumulated sufficient inventory. That's when distribution begins, not to create excitement, but to transfer inventory from strong hands to weak ones. Think about basic supply and demand. When a large participant needs to distribute a position, they can't simply dump it all at once. That would crash price and result in poor execution. Instead, they distribute gradually, often into strength, using market enthusiasm to exit positions. Daniel learned this watching Bitcoin. After experiencing several false breakouts, he adjusted his approach. He waited, studied, and noticed a pattern. BTC had consolidated under $30,000 for an extended period. Then came a sharp spike above 30K, followed by an immediate rejection to 28.5K. Many traders called it a failed breakout. But Daniel observed something different. After the shakeout, volume characteristics changed. Selling pressure decreased. Price began building a base. So, he waited for confirmation. 2 days later, price approached 30K again, this time gradually. Then came a surge in volume with strong price response. Price cleared 30K and continued to 31.2K, then 33K, then 34K within 48 hours. The initial spike had cleared stops above 30K. The rejection had triggered stops below. This created a cleaner market structure for the actual move. Here's the crucial understanding. Institutional moves often appear violent and unexpected because they occur after preparatory phases. They don't warn you with perfect patterns. They happen when positioning is complete and path of least resistance is clear. Statistical analysis of major market moves shows that over 60% occur from areas of prior rejection. This isn't coincidence. It's the result of systematic position building, followed by distribution. So, ask yourself, are you trying to catch every potential setup? Or are you willing to wait for high probability opportunities? Can you remain patient while markets build structure? Because mastering patience in trading is often more valuable than mastering patterns. Once you understand institutional behavior, you stop overtrading and start waiting for optimal conditions. But understanding these concepts requires practical application. And that brings us to risk management. Before we continue exploring market dynamics, let's address the most critical aspect of trading success: risk management. Because understanding patterns without managing risk is like learning to drive without wearing a seatbelt. Professional traders don't succeed by being right all the time. They succeed by managing risk when they're wrong. Studies show that even the best traders are only right 50 to 60% of the time. What separates professionals from amateurs isn't win rate, it's risk control. Let me share Daniel's evolution. Initially, he focused entirely on finding perfect entries, but after several large losses, he realized entries were only part of the equation. He implemented strict risk parameters, never risking more than 1 to 2% per trade, using stop losses based on market structure, not arbitrary percentages, sizing positions based on volatility, not emotion. Here are fundamental risk management principles every trader must understand. Position sizing is paramount. If you risk 10% per trade, just 7 consecutive losses put you down 50%. But risking 2% per trade, you'd need 35 consecutive losses for the same drawdown. Mathematics favors conservative position sizing. Stop losses aren't suggestions, they're mandatory. Place them based on market structure, beyond likely volatility, but close enough to maintain favorable risk-reward ratios. A good rule is risking $1 to potentially make 2 or 3. Diversification matters. Don't concentrate all capital in correlated positions. If you're long multiple technology stocks, you essentially have one position with multiplied risk. Have a trading plan. Define your entry criteria, exit criteria, and position size before entering any trade. Emotional decisions during trades rarely end well. Track your results. Keep detailed records of every trade. Win rate, average winner, average loser, maximum drawdown. You can't improve what you don't measure. Most importantly, protect your capital. You can recover from missed opportunities. Recovering from large losses is exponentially harder. Type protected in the comments if you commit to implementing proper risk management. Because this isn't optional for long-term success. The market will always present opportunities, but you need capital to take advantage of them. Protecting capital isn't just about avoiding losses. It's about staying in the game long enough to succeed. Now let's explore how volume analysis reveals institutional behavior. Section 7. Volume profile and market structure. Markets don't move in straight lines. They move through zones of acceptance and rejection, areas where price finds equilibrium or experiences imbalance. Understanding these zones requires looking beyond price to examine volume distribution. Volume profile analysis shows where transactions actually occurred, creating a map of market activity. Unlike time-based volume, it reveals price levels where participants were most active. This isn't traditional support and resistance. It's a view into market structure based on actual trading activity. Think of market structure like geological layers. Some areas are dense with activity, others are sparse. Institutions navigate these zones strategically. They accumulate in high-volume areas where liquidity exists. They drive price through low-volume areas where resistance is minimal. Daniel discovered this analyzing his failed trades. Price would respect certain levels repeatedly, then suddenly slice through others. Traditional support and resistance couldn't explain it. But volume profile revealed the truth. Areas of high volume, called high-volume nodes or HVN, acted as magnets. Price would gravitate toward them. Areas of low-volume nodes, or LVN, offered little resistance. Price would accelerate through them. Academic research supports this. A 2022 study in the Journal of Financial Markets found that 73% of major reversals occurred at high-volume nodes, while 81% of breakout accelerations happened through low-volume areas. But here's what makes this powerful. High-volume nodes represent price levels where the market found agreement. Both buyers and sellers transacted heavily. These become areas of memory. When price returns, participants remember their previous decisions. Low-volume nodes represent rejection. The market spent little time there. Few participants have positions at those prices. This creates a vacuum effect when price enters these zones. Understanding this changes how you view charts. Instead of drawing arbitrary lines, you're seeing where actual trading occurred, where positions were built, where stops likely cluster. Have you ever noticed price accelerating through certain levels while stalling at others? That's volume structure in action. The market has memory, and volume shows where that memory is strongest. So don't just analyze price patterns, understand the volume structure beneath them. Because institutions don't care about your trend lines, they care about liquidity, and volume shows where liquidity lives. But sometimes the areas that appear safest are actually the most dangerous. Popular trading wisdom says to buy support and sell resistance. Find levels where price bounced before. Trust the areas where volume was highest. But what if those very places, those safe zones, are actually where risk concentrates. This is the paradox of liquidity clusters. In warfare, there's an ancient principle. The fortress that appears strongest often hides the greatest vulnerability, because everyone seeks shelter there. In trading, high-volume areas where everyone trades create similar dynamics. They feel safe, they look strong, but they also concentrate stops, which creates opportunity for larger participants. Daniel learned this the hard way. He identified a clear high-volume node on Ethereum at $2,120. Price had bounced there multiple times. Volume confirmed it as support. When price returned to this level, he bought confidently, but price didn't bounce. It consolidated briefly, then broke down sharply to 1980. Checking social media, he found hundreds of traders had the same idea. They all trusted the high-volume support. They all placed stops just below, and they all got stopped out together. But what really happened requires understanding market microstructure. High-volume nodes attract traders because they represent prior agreement. But this concentration creates vulnerability. When too many participants have similar positions with similar stops, it creates a liquidity pool. For institutions needing to build positions, these pools provide the volume they need. Research by the European Central Bank found that over 65% of stop-loss clusters occur within 2% of high-volume nodes. This isn't conspiracy. It's structural. Traders naturally place stops near obvious levels. The insight here challenges conventional thinking. The most obvious levels are often the most dangerous, not because they're fake, but because they're crowded. When everyone sees the same thing, no one has an edge. So, have you ever been stopped out at a level that seemed unbreakable? Lost money at strong support that suddenly wasn't? You weren't wrong about the level being significant. You were caught in a liquidity cluster. Type cluster. If you've experienced this, your recognition helps others learn. The solution isn't avoiding these levels entirely. It's understanding their dual nature. They can be support, but they're also liquidity pools. Trade them with awareness of this dynamic. Use wider stops. Wait for confirmation after tests. Or better yet, wait for the liquidity grab to complete before entering. Because the best entries often come after the obvious trades fail. Section 9, Order Flow and Market Intent. You may never see institutional positions directly, but you can observe their footprint through order flow analysis. This is where price action meets volume to reveal true market intent. In nature, you might not see the predator, but you can see signs of its presence. Disturbed grass, fresh tracks, changes in prey behavior. Markets leave similar clues. Order flow analysis reads these signs. It shows not just where price went, but how it got there, the struggle between buyers and sellers, the moments of aggression versus absorption. Order flow tools like footprint charts strip away the simplified view of candlesticks. They reveal the auction process underneath. Every transaction, every imbalance, every moment where one side overwhelmed the other. Daniel's breakthrough came when he started using order flow analysis. Reviewing his Solana trade, he saw what candlesticks had hidden. As price approached $120, buy orders were hitting the ask aggressively. Volume was strong, but the footprint revealed something crucial. Despite aggressive buying, price wasn't responding proportionally. A large seller was absorbing every buy order without moving price higher. This is called passive absorption. When one participant provides liquidity without being aggressive, they let others come to them. It's like a dam holding back water. Eventually, either the dam breaks or the water finds another path. In this case, once buyers exhausted themselves, the seller became aggressive. Price collapsed from $125 to $92 rapidly. The footprint had revealed the setup in real time. Aggressive buying meeting passive selling equals potential reversal. Studies on order flow show that 78% of major reversals exhibit this absorption pattern before the turn. It's not perfect, nothing in trading is. But it provides valuable context that price alone can't show. Here's what makes order flow powerful. Price shows you the result. Order flow shows you the process. When buyers push hard but price doesn't respond, that's information. When sellers dump but price holds, that's information. These imbalances reveal institutional activity. The practical application is this: stop trading based solely on price patterns. Start incorporating volume and order flow analysis. Look for divergences between effort and result. Aggressive activity without price response often precedes reversals. Have you ever sensed something was wrong with a setup but couldn't explain why? Your instincts might have been detecting order flow imbalances that charts didn't show. From now on, don't just ask where price is going. Ask who's in control right now, because understanding who's winning the auction is more valuable than predicting the outcome. But even with these tools, you need to understand the bigger picture. Section 10, Market Cycles and Institutional Phases. Markets don't move randomly. They follow cycles, repeating patterns of behavior that reflect the interaction between different participant types. Understanding these cycles helps you anticipate what comes next. The classical market cycle has 4 phases: accumulation, markup, distribution, and markdown. But let's understand them through the lens of institutional behavior rather than just price action. Accumulation occurs when informed participants quietly build positions, while the broader market remains uninterested. Price moves sideways, volatility contracts. Financial media ignores the asset. This is where patient capital operates. Institutions accumulate slowly, absorbing selling pressure without alerting others. Research by the CFA Institute shows that accumulation phases typically last 3 to 5 times longer than distribution phases. Patience is required to build large positions without moving markets. Markup happens when accumulation is complete and supply becomes scarce. Price breaks out of the range. Volatility expands. Media attention increases. This is where accumulated positions become profitable. The key is that markup doesn't begin randomly. It begins when supply and demand dynamics shift. Distribution is the opposite of accumulation. Informed participants sell into strength while broader market enthusiasm peaks. Price may still rise, but internal strength weakens. Volume patterns change. Leadership rotates. This is where patient capital exits while emotional capital enters. Markdown completes the cycle. Once distribution is complete, price declines as reality sets in. Volatility spikes. Media turns negative. This creates the next accumulation opportunity for patient participants. Daniel observed this cycle repeatedly. Bitcoin's move from 25K to 34K followed the pattern perfectly. Weeks of accumulation under 25K that felt endless. A sharp shakeout to 23.5K that cleared weak hands. Then explosive markup to 34K that caught most off guard. Finally, distribution between 30K and 32K, disguised as consolidation. 2 weeks later, markdown brought price back to 27K, completing the cycle. The crucial insight is this: these cycles aren't drawn by price levels. They're created by participant behavior. Patient capital accumulates when others are fearful, distributes when others are greedy. The cycle repeats because human behavior repeats. So, have you been trying to catch moves without understanding what phase the market is in? Fighting the cycle instead of flowing with it? Comment cycle. If you're beginning to recognize these phases in your markets, pattern recognition improves with practice. Understanding cycles doesn't predict exact turning points, but it provides context for probability. Buying during accumulation and selling during distribution aligns you with institutional flow rather than against it. Section 11. Patience and position timing. You don't need to catch every move. You need to catch the right moves at the right time. This requires more patience than most traders possess. The paradox of trading is that doing less often achieves more. While others chase every breakout, overtrade every pattern, the patient trader waits. Not for perfection, but for probability. Not for certainty, but for confluence. Daniel transformed his results when he embraced patience. During the 2025 altcoin season, while others chased momentum, he developed criteria. He looked for completed accumulation phases, clear volume patterns, order flow confirmation, risk-reward ratios above 3 to 1. When these factors aligned, he acted. When they didn't, he waited. His win rate didn't dramatically improve, but his average winner versus average loser did. By being selective, he caught larger moves with better entries. Quality over quantity became his edge. Statistical analysis supports this approach. A study of 10,000 retail trading accounts found that traders who made fewer than 10 trades per month outperformed those making 50-plus trades by an average of 47% annually. Overtrading is the enemy of profitability. Think of trading like fishing in the ocean. You could cast your line constantly, hoping for action. Or you could study the tides, understand the patterns, and fish when conditions favor success. The patient fisherman often catches the biggest fish. Here's what patience really means in trading. It's not inactivity, it's selective activity. While waiting, you study, you prepare, you refine your process. Then when opportunity presents itself, you're ready to act decisively. The market will always offer another opportunity. Always. The fear of missing out drives poor decisions. But missing one move to catch a better one isn't a loss. It's strategy. Have you ever forced a trade because you felt you needed to be active? Entered a suboptimal setup because you were bored? That's impatience costing you money. From now on, define your criteria clearly. Wait for your setups. Accept that waiting is part of the process, because the best trades often come to those who wait for them. Trading isn't about constant action. It's about right action at the right time, and timing requires patience. But even perfect patience needs one final element. Section 12. The moment of confluence. There are moments in trading when everything aligns, not daily, not weekly, but occasionally multiple factors converge to create exceptional opportunities. These are the trades that define careers. Confluence occurs when technical structure, volume patterns, order flow, and market cycles align. It's not about finding perfect setups. It's about recognizing when probability strongly favors one direction. These moments are rare, but they're worth waiting for. Daniel experienced his first true confluence trade during Bitcoin's 2025 halving anticipation. Price had consolidated near $34,000. Most traders were divided between exhaustion and continuation, but Daniel saw convergence. Volume profile showed accumulation. Order flow revealed absorption of selling pressure. The broader cycle suggested markup phase. Risk was clearly defined below 33K. Reward targeted 42K minimum. Everything aligned. He entered with conviction, not hope, not fear, but calculated confidence based on multiple confirming factors. Over the next 72 hours, Bitcoin surged past 42K without significant retracement. The move appeared sudden to most, but to those reading the signs, it was logical culmination of building pressure. What makes confluence powerful isn't any single factor, it's the combination. When structure, volume, flow, and cycle align, probability shifts meaningfully. Not to certainty, nothing offers that, but to favorable odds worth acting upon. Research in behavioral finance shows that the best performing traders wait for confluence. They don't trade single patterns or indicators. They wait for multiple factors to align. This reduces false signals and increases conviction when acting. The practical lesson is clear. Stop looking for one perfect indicator or pattern. Start looking for confluence. When multiple factors point the same direction, probability improves. When they conflict, patience is warranted. Have you ever felt everything clicking into place on a trade, where multiple factors aligned perfectly? That's confluence, and it's worth waiting for. Type confluence if you're committed to waiting for these high probability moments. Remember, you don't need many of these trades. A few high conviction, well-executed confluence trades per year can define your results. Quality over quantity, patience over activity, confluence over confusion. Swim with awareness. So, now you've seen beneath the surface. You understand how large participants operate, how volume creates structure, how order flow reveals intent, how cycles repeat, how patience pays, how confluence creates opportunity. 12 lessons. 12 perspectives on market dynamics. You no longer need to chase every move. You can wait for probability. You don't need to predict perfectly. You can read what's happening now. You've learned that successful trading isn't about outsmarting the market. It's about understanding its nature and adapting accordingly. Let's recap the key principles. Markets move based on liquidity, not lines. Large participants accumulate patiently, then distribute strategically. Volume creates memory and structure. Order flow reveals the battle between buyers and sellers. Cycles repeat because behavior repeats. Patience and selectivity outperform hyperactivity. Risk management is non-negotiable. Confluence creates the best opportunities. So, here's your moment of reflection. Have you been trading against the current, or have you simply not understood how the current flows? If markets have felt frustrating, maybe you've been focusing on the wrong things. But now you have new perspectives. The next time you see consolidation, remember accumulation. The next time you see a breakout, check the volume. The next time you feel impatient, remember that waiting is part of the edge. Now, I want to hear from you. Comment below. I will trade with patience and awareness. If this video gave you even one valuable insight, share that insight in the comments. Help others learn from your recognition. Remember, successful trading isn't about perfection. It's about probability, patience, and process. The market always provides opportunities. Your job is being prepared when they arrive. Subscribe to Trading Psychology. Stick for more deep dives into market psychology and institutional dynamics. Next week, we're analyzing 3 specific case studies showing these principles in action across different markets. Real trades, real analysis, real lessons. Until then, trade with awareness, not anxiety, patience, not panic, and always protect your capital first. The market is an ocean. You don't need to conquer it. You just need to learn to navigate it safely.